Hello students, welcome to week 6 of the Accounting Principles class. Be sure to watch this week's devotional and don't forget to read the assigned chapters from the course text. All right, let's take a look at week 6's learning objectives. This week is all about cash flow. We are learning about the principal purposes and concepts underlining the statement of cash flows and identifying its components and format rather. We're going to look at the indirect method to determine cash flows from operating activities, investing activities, and financing activities. And we'll take a look at how to analyze the statement of cash flows for a business. As a reminder, the statement of cash flows shows how a company's operating, investing, and financing activities have impacted cash during the period. It helps explain the net increase or decrease in cash during some given accounting period. And you should recall this from um, Accounting Principles 1, where we spent a little time talking about cash flows. But now the cash flow statement, now we're digging into it a little bit more. And also a reminder about the definition of cash. Cash is defined as including both hard cash, like you might have in the bank, or cash equivalents, which would be things, investments that you can quickly convert into, say, hard cash within 90 days. Management uses the statement of cash flows to assess liquidity, determine how much of a dividend to pay if the business has stockholders, for example, and understand the effects of major policy decisions involving investments and financing needs. From this graphic, you can see the typical inflow and outflows of cash categorized by operating activities, investing activities, and financing activities. Now, one of the big financing activities at my place of business where I work is the line of credit that we hold at a local bank. Now, we use that line of credit to help us finance expansion. Sometimes we have to use it to pay suppliers and even employees if time gets tough and cash is starting to dry up a little bit. So maintaining a line of credit at a local bank will help you solve some of the short-term cash needs that you have when you need it. As shown in this graphic, preparing a statement of cash flows involves preparing four, call them mini cash flow statements, if you will. Step 1, the first mini cash flow, is determining cash flow from operating activities. The next is determining cash flow from investing activities, and then determining cash flows from financing activities. And then the fourth step is putting it all together, combining all those mini cash flows, if you will, into a final statement. You should check out the details on these steps in the course text that talks a little bit more about them in detail. Now, after preparing the cash flow statement, there are a few key measurements that you should calculate to see the health of your business from a cash perspective. Remember, cash is king in a business. Without it, you can have the best looking income statement, but if you don't have cash, you don't have anything. The first measurement is cash flow yield. This measurement simply measures the amount of cash generated for every $1 of net income that the business produces. Basically, it's a measure of how well your business is generating cash based on revenue expenses, once revenue expenses have been netted against each other. Another important ratio is the cash flows to sales ratio. It's the ratio of net cash flows from operating activities compared to sales. So how much cash is generated by every $1 of sales is what this measures. If you have a lot of sales, but it's not generating cash, then maybe your customers are not paying their bills on time to you. Think about the accounts receivable discussion earlier in the term. From this slide, you can see that cash flows to assets is another ratio of another way to measure the net cash flows. It's comparing operating activities to the average total assets. Your company's assets should be working for you, should be generating cash for you. Otherwise, maybe it's not an asset, it's an anchor. Might be a liability. If this ratio decreases over time, start doing a review of your assets and maybe it's time to dump some of them and just squeeze the cash out of them and get rid of them and move on. And finally, Free cash flow is the amount of cash that remains after deducting the funds of a company, the funds that a company must commit to continue operating, to continue operating, paying its bills, and meeting its obligations. Um, Basically, cash flow is kind of like what's left over after the month. Put it in personal terms. Free cash flow, though, can be positive or negative. So, just like it sounds, positive free cash flow means the business has money left over to reduce debt or to expand. Negative free cash flow means that the business will have to sell its investments, borrow money, hit that line of credit, or issue stock in the short term to continue operating. In the short term, when this sort of thing happens, and it does happen to businesses, you can survive it. But over a long period of time, negative cash flow, uh, the ship basically runs ashore, runs aground, and it can't float anymore. The business is done. So to be sure, you're watching these cash flow metrics and ratios when you have a business of your own. And be a good steward of what God has given to you. Okay, that's it for now. Remember to get your discussion questions and quizzes done on time and your assignments done on time. And remember, God is on his throne. He's always been there. He's always going to be. Have yourself a great week.